Hey dudes and duderinas, this is the Finance Dude. As already explained in the first video of the Finance Dude's method, which you can find at the top right, this method consists of 3 steps. The first is the Analysis 1.0, the second is the Analysis 2.0, and the last one is called the Endless Analysis. This is the video where I explain the second step of my method, or Analysis 2.0. As we go through this method, the narrower it gets. Bad businesses fall behind, while good companies continue their analysis journey toward a narrower Analysis 2.0, a more detailed breakdown of the company that introduces a qualitative assessment of the company and industry. We may have found in Analysis 1.0 what it seems an outstanding business and we can feel excited and have all these feelings about it, but the stock doesn't have any feelings for you nor is particular excited with you. A much deeper analysis is needed to give the answer to unanswered questions from Analysis 1.0 and find questions that we didn't even have in the first place. A quick note here. I don't want to seem presumptuous, claiming that every bad company will fall behind and every good company will advance in this analysis. We all know things in the investing world don't work like that. Other things are necessary besides processing some numbers. But I am sure this method improves the probability of success. After all, investing is constantly improving our probability of success. No one can be sure 100% of the time. Not even Warren Buffett, Peter Lynch, or Bill Ackman. The best I can do is to compile, process, and analyze the data that I have available at a given moment. Most of the time, this is what it takes to succeed and outperform the market in the long run. Let's now start with the different steps of this Analysis 2.0. The first step of this analysis is to have a look at the news around the company. It's a critical step to learn about the current state of the business and what the markets are focused on. Either good news or bad news, this keeps us up to date with the reality around the company. The next step is to have an in-depth look at the company's business and other financial statement elements. In this section, the focus is on industry-specific metrics such as daily active users, monthly active users, average revenue per user for social network companies. These types of metrics will vary across industries and some industries don't have any ratios where we can guide ourselves. The following key step is to segregate the revenues. The goal is to have a comprehensive perspective of which segment brings the golden eggs and the trends in the different business lines. Analyzing trends in the various business segments allows us to anticipate whether the golden egg segment is losing steam due to factors such as being disrupted, competition, inability to find more growth, or the markets being already saturated. On the other hand, it allows us to notice whether any new business segments are emerging and where we can start to anticipate a new source of growth. This section also includes a thorough analysis of the financial statements. It starts by analyzing the trend of the different expenses as a percent of revenue. Cost of revenue, selling, general and administrative expenses or SG&A, research and development expenses or R&D, and other operating expenses. In Analysis 1.0, I evaluate the operating margin in the 5 dimensions section to see whether the company is increasing or decreasing its operating margin. In this second analysis, segregating the operating costs allows an in-depth look at where the company's margins have been improving or deteriorating. This comprehensive analysis also includes a deep dive into capital expenditures, or CapEx, trends. CapEx is used to acquire, upgrade, and maintain physical assets such as property, plants, buildings, technology, or equipment. Growth in CapEx aims to fuel growth through new products or services and/or expand its existing operations. We have a recent example of Facebook which increased its annual CapEx spending by $10 billion to accelerate the metaverse technology. If this bet will pay off, I don't know, and markets aren't optimistic about it, but they are betting big on this. We also have the example of telecommunication companies that have been investing heavily in 5G technology over the last few years. This additional spending is very cyclic for some industries, and we should be aware of this when investing in a new business. Another data point that it's imperative to explore is the cash acquisitions done by the company during the past years. Are they burning cash on meaningless acquisitions? How are they integrating the acquired businesses into their operations? Are the expected synergies a success? Is the company growing only through acquisitions? These are all relevant questions to which we should seek answers. It's also key to analyze the debt levels of a company and its sustainability. In this step, I evaluate if the amount of debt being issued and repaid each year is sustainable. Is the company issuing much more debt than it is repaying? Is the business already too much indebted? Or does it still have room to accommodate higher degrees of leverage? It is concerning to find an organization adding more debt to its books when it already has high debt to cash flow or debt to equity ratios. Even more in the context of increasing interest rates. As explained before, understanding how much a company is spending or receiving through shares repurchases or issuance is also critical. How many millions or billions is the company receiving by diluting its shareholders? And what is it doing with the money? Should we expect a share repurchase program? After paying the shareholders, how much of the free cash flow do they keep? To round out this section, I compare stock-based compensation with the company's share price. Is the management being too generous to themselves with no reflection on the share price or in the return to the shareholders in the form of dividends or shares repurchases? Do we want to invest in a company where management's compensation skyrockets, but investors receive little to no return for investors? As you can see, there are numerous questions to be asked before investing in a company. If we can't answer them using the information given on financial statements, at least we know what questions we should seek for answers. If any questions remain unanswered before making my decision on whether I want to invest in the company, I will consider their relevance, if they are blocking points or something that isn't too concerning. I may also ask for your opinion. I intend to assemble a great team of investors with specialists across various industries. We are a team, a community, and we are all in this together. If you want to be a part of this community of investors, please consider subscribing to the channel, turning the bell on, and hitting the like button. In this peers comparison section, the goal is to compare the already analyzed 5 Ds of the target company to those of its industry peers. I make the same analysis on the competitors as I did in Analysis 1.0 on our target company. The purpose is to compare each other's ratings to understand if, in this industry, I am analyzing the best available company in the market. Often, I find a competitor that can bring even more value than the company under analysis. Either because it's more profitable, have higher growth, is less leveraged, isn't overvalued, is more shareholder friendly, has a better business model, or has competitive advantages that our target company doesn't have. If that's the case, I will conduct a deeper analysis, aka Analysis 2.0, to confirm whether the numbers, ratios, and metrics were telling the truth and if I just hit the jackpot. The purpose of this piece is to read, dissect and comment on the Management Discussion and Analysis section of Annual Reports, 10K, our quarterly filing, 10Q. As mentioned previously, when analyzing a business, it's vital to have a take on what the management says. Many times, there are questions unanswered from looking through its financials, and reading management's comments can help us find answers to those questions. Moreover, we can obtain useful information from the company's business, industry trends, or valuable takeaways on the global economy. Unfortunately, management is not always truthful and has incentives to sugarcoat some events, leading the investors to assume all is well. Or even to tank expectations for the upcoming quarters just to beat expectations when those quarters come. I don't want to say they will always lie about the numbers. I just want to alert you that these tactics are old and occur frequently. Luckily, you have the finance dude to look for these things. A business analysis wouldn't be complete if we weren't aware of the risks a company faces. One of the most critical relationships in finance is the one between risk and return. For higher degrees of risk, a rational investor demands a higher return. It's a straightforward relationship. Let's look at the example of U.S. Treasury bonds versus corporate bonds. Naturally, the U.S. Treasury bond will pay a lower interest rate than the corporate bond because, historically, the U.S. government has been less likely to default than any given company. Therefore, corporate bond investors demand a higher return for the additional risk they are taking. The same applies to equities. Because bonds rank higher in seniority than equities, this means that, if a company declares bankruptcy and faces liquidation, bondholders will be paid first than shareholders. Equity investors demand a higher premium for their investment due to the high degree of risk. Even inside equity investments, some companies are riskier than others. We can't say that a company like Apple has the same risk as Hertz, which recently filed for bankruptcy. Given this, assessing a business's major risks is of the utmost importance. Knowing the risks that a company faces allows us to make a reasonable assessment of their likelihood. Naturally, the risk of the U.S. government default isn't the same as the risk of additional regulations for big tech or regulations against oil companies or any other business impacting climate change. In this section, I will attempt to map a company's primary risks so it's easier to anticipate and adapt to any escalation of any of them. Another important aspect of the analysis is being aware of what the management is doing with their shares. In this section, I will have a look at the main insider transactions. Undoubtedly, they are the people with the best information available. So if they are all selling, it isn't a good indicator, is it? It doesn't mean that they don't believe in the company's ability to perform. But they may think the company is overpriced, as it happened during the COVID bubble. Examples of that were Elon Musk and Jeff Bezos. If the 2 richest people on Earth are selling their stock, why wouldn't you? Tesla and Amazon are 2 of the greatest companies in the world. However, everything was overly priced in 2021. I can't condemn them for taking the profits. What I can't also condemn are those who subscribe to this channel and hit the like button. On the contrary, if they are massively buying, then there's another positive indicator for the company. I have a maxim that I don't invest in a company unless I've listened to at least the most recent earnings call. This section aims to thoroughly analyze the earnings calls, the last investor day, if any, and the company's most recent guidance. These will be helpful when making our model's assumptions. In earnings calls, I frequently find answers to previously unanswered questions that I had and start connecting the dots. I may also find that Wall Street analysts have the same questions as I have. Or I may even find better unanswered questions that they make, and I haven't thought about that. These are specialists that have been following the industry for years and always have valuable insights and pertinent questions that we should listen to. In addition to this factor, I personally enjoy listening to how the management answers these questions. Sometimes they are evasive, sometimes they get nervous with some questions, and sometimes they give us extra value that cannot be found in their 10K comments. I really feel that investors often underestimate the value we can obtain from these calls. Investor Day is also an important event where companies may make huge announcements such as a new product or service in development, their pipeline, their long-term outlook, and where they see the business going in the following years. It's exciting to see the future through the management's eyes, but it is also essential to take it with a grain of salt because they don't need much to build castles in the sky for us. This is just one data point in a set of this complete analysis. Just because we like the story a CEO is telling us, it doesn't mean we are paying a fair price. If everything they say and do goes right, the price can still drop. Not all good companies are good investments. Price matters. After going fully deep into the analysis of the company, I am now in a better position to make new and better assumptions for the DCF valuation model. In these new assumptions, I can now incorporate strengths or risks that were unknown when I first made the DCF valuation in Analysis 1.0. For example, I can now integrate whether there are any exciting products in the pipeline that might bring additional growth. If there are new trends in the different segments and how they impact overall profitability. If the management is optimistic or pessimistic about the future of the business. If it will go through hard times in the upcoming months or years due to external factors and macroeconomic conditions. If there are better competitors in the market. If it's on the brink of being disrupted and losing market share. Or how do Wall Street analysts expect the business to perform in the upcoming years? The valuable information acquired in this comprehensive analysis 2.0 will be essential for a better DCF valuation. Will I have a more accurate estimate? Undoubtedly. Will I be right? I don't know. Even after all this work and information, there's still so much to learn and incorporate and so much uncertainty in the future. But one thing I know for sure, this analysis increased our probability of success, and we will undoubtedly be rewarded in the long run, even if that means we won't be right 100% of the time. For the multiple valuation, I will simply update all the variables necessary for the multiple calculation and check how it has trended compared to Analysis 1.0. With this second analysis, we increased our probability of success and are finally in position to make a final decision about the company. If I was wrong about a business in Analysis 1.0, I hope to find its flaws in this Analysis 2.0. If I confirm that it's indeed a great business to buy, I need to look at the price. Is it overpriced? If it is too expensive and since it's a great business, I don't want to lose sight of the stock. I add it to a watch list, follow up closely, and patiently wait to reach my investment range. If it never reaches my investment range, I will go on with my life looking for other great companies. There's a lot of fish in the sea. Or is it already in the price range I want? That's what I want to hear. Good businesses at the right price. The dude will gladly put its money into the business and wait for the sweet fruits of compounding. Compound interest works, believe me. Thank you for watching, and if you identify yourself with this channel and are interested in learning more and having access to the best analysis process out there, please consider following the dude in social media, subscribing to the channel, turning the bell on, hitting the like button, and sharing with your friends and family who would benefit from following this channel. You can also increase your support by subscribing to the Patreon page. The link is in the description. It would help the channel a lot and the dude would be forever grateful to you. We are in this together, dudes. Let's go.